Good morning, everyone. Welcome to the first of 4 webinar created by compliance company RWA. My name is Chris Withers and I'm the Broker Distribution Director for Ecclesiastical. We're bringing you these webinars to help you navigate through the latest requirements set out by the FCA. The changes impact all of us, whether we're manufacturers, co-manufacturers, distributors, or in old language, insurers, brokers, and that's brokers, whether the schemes brokers, commercial brokers, private client brokers. It impacts us all, and anything that is focused on the customer is something that will be important to Ecclesiastical, but we want to help you to understand what these changes mean to you and what that will mean from the way in which we all do business in the future. We are recording today's session. Just as a reminder, if you can turn cameras off and keep yourself on mute, that would be great. That'll just help with bandwidth. There will be time at the end for questions, and I'd ask that you just hold on to those questions until the end when I'll return and facilitate a question and answer session, and we'll do that through the chat function. But in the meantime, I'm going to hand over to John King, who will introduce himself and take you through the content. Thank you.
Good morning, everyone, and thank you very much, Chris. It's great to have so many people here today. I'm John King. Some of you may know me. I was at the FCA for 16 years, and most of that time was in insurance supervision. I'm now, in addition to working with RWA, I'm also a non-executive director at A Plan Group and a chair SMF9 at another firm. So this enables me to see the issues from a number of angles and have some sympathy with you, because obviously we're going through it as well. I'm delighted to be working with Chris and Ecclesiastical on this very important topic. Can I have the next slide, please, Nick? So as Chris said, we've got 4 webinars coming up, and I think that just shows that's because how big a topic this is. We've split it into 4 sessions. Today is I'll be giving you an overview of the rules, and then in the next 3 we'll be going into more detail on product governance, pricing practices, and the reporting requirements. Next slide, please. So we have the pricing practices final rules. I mean, this has been a long time coming. Treasury Select Committee has been going on about this for years. The Citizens Advice Bureau filed a super complaint, but now perhaps we have the end in sight. The final rules were published in May 2021, all 217 pages of them. And I've split that into 2 sections. The pricing practices, which has gained most of the headlines, and that's aimed at private motor and home insurance, and the implementation date of that is the 1st of January 2022. But the one that perhaps has sort of sneaked in under the radar is those on product governance. But I would say the product governance requirements are bigger and affect virtually all insurance products, and that implementation date is fast approaching with 1st of October, a couple of weeks time. So please don't nod off during this session. Next slide, please. So what's the impact of all this? Obviously, as Chris said, and certainly the FCA, they look at things from the customer point of view. And I would say this is one of the largest ever regulatory changes for insurance pricing. I mean, from the FCA's studies, they found that customers could have saved, a lot of money. And, there's some big numbers here. So this is a high profile project for the FCA. But, on the pricing, it's not a case of the customer wins at the expense of the insurance industry. A lot of that 4 billion figure is a redistribution amongst customers, whereas those customers that have, perhaps in the past have been quite savvy and shopped around and got the good deals, they might see their motor and home prices go up, whereas those that have remained, loyal with their customers, perhaps vulnerable, press might say have been ripped off, the loyalty penalty, etc., will see their premiums coming down. Certainly that's what the FCA is expecting and hoping to happen. That price differential between new and existing customers is reduced. And then on product governance, this is really value has been an FCA mantra for a while now. Customers do not receive poor value products or products that do not meet their needs. And I would say that the differential pricing argument, and the FCA chief economist has sort of said this in speeches as well, really that pricing big debate and discussion is just a subset of the value argument. Those loyal customers who've perhaps been exploited with their pricing have not been getting value from their insurance products. Can I have the next slide, please? And so what's the impact on you, the firms? Well, I think the FCA believes that firms have been slow to react on this. There's been a lot of warning and a lot of consultation process, was going on for years about this. But only just very recently, end of August, the FCA fired a shot across the bows to say that firms were struggling to comply with the existing product governance rules, let alone the new ones that are coming in force. And some of you may have received in July these preparedness surveys. It seems to be the flavour of the month from the FCA, sending out lots of surveys. But there was one that was sent to a sample of insurers, PCWs and brokers on how ready they were for these new rules. But in defence of the insurance industry, this is a massive change, and certainly on the pricing side of things, going to require perhaps a lot of IT development. So there's reliance on the software houses. And to be fair to the FCA, they did recognise this and push the implementation date back for the pricing to the sort of 1st of January. And despite 217 pages of rules coming out in May, they still provided some updates in August, which I'll touch on to, and we're in fact still waiting for the final attestation wording, which the FCA will be coming out shortly, in their words. Can I have the next slide, please, Nick? So, pricing practices then, and really on this slide is the key rule. So I would say, if you're ever in doubt about, what should we be doing here, I think this is the key rule to refer back to. A firm must ensure that it does not systemically discriminate against customers based on their tenure. And that's from the ICOBS, the Insurance Conduct of Business section of the rule book. So as I said earlier, what the FCA is trying to do with this here is an end to the price walking, the loyal penalty, the dual pricing, whatever you want to call it. And I think we would all agree that this is a good thing. And despite various attempts, the insurance industry has not been able to has wanted to, but has not been able to sort this out itself. So it's required regulatory intervention. I'm sure we've all heard the stories or come across people where usually it's an elderly relative who's been with their same provider, often a bank, when they got the mortgage for their home insurance for a number of years. Their younger relative looks at their insurance and finds that they're paying like £900 for an existing renewal, when that person can get it for £200 as new business. That I think we would all agree is a bad thing. But although I've given you one rule there, obviously there's the devil in the detail and 217 pages of rules. So there's a lot more than just looking at that one rule. Can we have the next slide, please, Nick? So this is the pricing remedy that the FCA is introducing. It applies to personal and home motor insurance, and the renewal price to a consumer must be no greater than the equivalent new business price, or ENBP as it gets abbreviated down to. And there's a lot of components obviously in that. So starting with the premium, and really I think obviously most motor and home insurance brokers should not be affected by this part. If they're just passing on to the client the premium set by the insurer, as that pricing rule falls on the existing insurer has responsibility to not set a renewal price greater than the equivalent new business price. And perhaps you as brokers are are also probably getting quotes from other insurers and shopping around on behalf of your customers. One area where the premium for a renewing customer can be more than an equivalent new business customer is where there's a change in the risk. And the good example given during the consultation process on that was telematics. So obviously, for a renewing customer, you now have a hell of a lot of driving data on that customer from having the black box in their car for a year. So you may know that they're a poor driver and want to increase the price based on the risk, when you wouldn't have that as if it was like a brand new customer who had just turned up. So that sort of differential price, or you might not even call that, you would call that risk-based pricing, is acceptable. Add-ons, any add-ons such as legal expenses, breakdown, key cover, etc., that's sold alongside the core motor or home policy is also caught by these rules. And so that's where you as brokers may be a bit more involved in terms of perhaps setting the price for that if you get a net rated product from your provider. Premium finance is also caught by these rules. I've got a couple of slides coming up on premium finance. And then you as brokers may set fees or charges to your customer. And again, going back to that prime rule that I said earlier, you should not be increasing fees and charges to customers the longer that they have been with you. As you can see, that is a way those customers could be price walked and discriminated against based on their tenure and how long they've been a customer with you. And then the final one, and perhaps there was a lot on this in the recent August rules that came out, is, well, discounts and incentives, because they are also caught by the rules in terms of incentives, cash or cash equivalents. But then, if those are offered and discounts are offered to new customers, they should also be offered to renewing customers, or again, otherwise you could see that you would be price walking those customers. So, that's 5 points there. So you can see how it covers, a lot of things, and basically probably everything that you're doing if you are a personal lines broker in motor and home insurance. Can I have the next slide? Right, I'm unmuted. Sorry, hopefully you can hear me. So yeah, premium finance. This is part of the pricing remedy rules. The APR on a renewing customer cannot be higher than an equivalent new business customer. I mean, I would have thought you probably don't do this anyway. It's really determined on credit risk of the customer and things. But I think the big point here is the middle bullet point. However, where brokers are setting the interest rate, and I think they probably are, you probably get a net rate from your premium finance provider, and then you determine what the customer pays, then that will make you what's called a price setting intermediary, and we'll come on to that in later slides. And premium finance is also part of the value discussion. The FCA have brought it into scope of that. And again, such as, are you acting in the customer's best interests, when there is a cheaper financing alternative from say the insurer? And that's not really a new requirement. Things like customers' best interests have been there since we had the Insurance Distribution Directive a couple of years ago. Can I have the next slide, please, Nick? In addition, on premium finance, there are also greater disclosure requirements coming into force from the 1st of January 2022. And what you must disclose, if you're not already, to the customer, the cost with and without premium finance, and also the difference between those two. State the fact that it's probably more expensive to take premium finance than paying it off up front, unless zero interest rate. and state that there may be a different duration of the policy and the premium finance. Obviously, the premium finance tries to get all the money in before the expiry of the policy, and hence the different term dates. So, I think premium finance rates do seem to be in the FCA's sights. Now, obviously, I'm not aware of that much response from the premium finance providers themselves yet, and I think they've got a big role to play in this, in helping out their broking customers. But if you know otherwise, obviously, please flag that up in the chat box. And as Chris said, certainly, welcome questions on this. For the later webinars, we may build on some of the questions if we don't get a chance to answer them today into the later webinars. So hopefully we can have a good interactive session. Next slide, please, Nick. So, what is price setting? I mean, thinking about it, really in, I suppose, common English sort of terms here. Well, can the broker change the end premium or total amount that is paid by the customer? And that can come up in a number of areas. Harking back to one of those earlier slides. The broker may determine the gross price after receiving a net price, and that can be both from the insurance products or the premium finance arrangements. The broker could set the fees and charges. That's obviously then within their influence. And some good news here, or slightly good news then. I mean, there's a lot of pushback in the consultation process. The FCA has conceded that although recognises that the brokers do set the fees and charges, this does not make them a price setter. But the quid pro quo for that, as I said earlier, is that obviously the FCA does not want to see you increasing fees and charges to customers the longer that they have been with you. And you must still report your fees and charges to the FCA, which we'll come on to. And then again, as I said earlier, if the customer starts haggling, and the broker gives discounts to customers, rebates some of their commission, or there's cash or cash equivalent incentives, such as free legal expenses for a year, or 10% off if you take a couple of products, then they are caught by the price setting rules, and so that's all price setting. Can I have the next slide, please, Nick? So, if you are deemed to be a price setting intermediary, then there are more onerous requirements. And so what are these implications and requirements? Well, there's an annual attestation to the FCA by an SMF, so a senior management function, or a director, such as a director at the firm, of confirmation of compliance with the rules. So therefore, record keeping and documentation will be key on this. I think the FCA would say, it's a very reckless director who's just signed off that confirmation without a lot of adequate supporting documentation to show that they are comfortable signing that off. As I said earlier, we're still waiting for that exact attestation wording to be issued by the FCA. They said it'll be coming very shortly. And then I think to show how seriously the FCA is taking all this, it mentioned things like anti-avoidance provisions, when it was in the consultation process and the rules. And that's one of the first times that I've seen the FCA do that in the process. And I think that just goes to show how seriously they take this. It's commented that it would take a dim view of firms or senior managers trying to get around the rules. I mean, in the recent Q&As that it issued, it was quite a brave or foolhardy firm that had asked the FCA the question, can we set up a different legal entity that does all the incentives? And I think, not surprisingly, the answer was no. And obviously, you must still take these rules into account. And then finally, by being a price setting intermediary, more of the reporting requirements will fall on you. So you will have greater reporting to do than the FCA to the FCA than if you weren't a price setting intermediary. Can we have the next slide, please? So I've mentioned this ENBP, this equivalent new business price. What is it? And I think, again, the reason it's important is it goes to the heart of the rules. Remember that the renewal price for a customer cannot be greater than the equivalent new business price. So how do you determine the ENBP? Well, I think for your renewing customers, you need to consider that customer, that exact same customer with that same risk profile, has come in as a new business, has come in again as a new business customer through the same distribution channel and through the same payment method. What price would you give them if that was the case? Obviously, it's a hypothetical situation. I haven't got a twin brother who you can use or things like that. But I think it shows what they are trying to do, and that needs to be worked out at the date of the renewal notice. Not at the point that the customer renews or the renewal date. When you send them the renewal notice. Obviously, if things start changing in the run up to renewal, then you may have to rework the ENBP, the equivalent new business price. And then I've got on there as the last bullet point, closed books. And so what are closed books? Closed books are where you have a portfolio of policies that you don't renew, that don't have any new business customers coming through anymore. And you can't sort of say, okay, well, that's all right, that the rules don't apply to me. Unfortunately, they do. And so you have to attempt to estimate what an equivalent new business price would be for those customers. Now, I wouldn't have thought it would affect that many brokers, but obviously it's something worth having a look at to see if you have got any books of business that might be deemed to be closed, that are not open to new business, and then what you have to do with that. That's probably going to be a sort of separate exercise, a separate piece of work that you would have to do. And obviously, happy to help. Next slide, please. So the reporting rules cover more, go into more detail on the fourth webinar, but as an overview today, well, what is required? Well, most of that reporting falls on the insurers and or the price setting intermediaries. However, all firms in the motor and home insurance space, either where they offer premium finance, where they set the price of add-ons, or charge customers fees and charges, are caught to some extent. And what the FCA wants, and there's a pro forma template, they've set that out already, a rep form that you'll have to send to them. The FCA wants data split by tenure of customer over 10 years to see if price walking. So that might require some system requirements, some system changes for you to be able to get that management information. The first report is due in September 2022, and that covers the first half of the year, and then there's annually reporting thereafter. And again, some other sort of slight good news. In the updated August rules, the FCA has conceded that where a broker rebates commissions or discounts to clients, this does not make them a price setting intermediary for reporting purposes. However, they still have to attest, and they must not, and then note how many number of contracts that they give commissions and discounts on, so that the FCA has that information. So in a way, that is another reporting requirement that firms are going to have to note down and keep an eye on. Now, all this is in part Nicole Rathie, the FCA's new CEO, who's been in the role for about a year now and replaced Andrew Bailey. He's publicly stated that one of his aims is that the FCA becomes a data-led regulator. And so, it's placing a lot more emphasis on reporting and collecting data. And I think, we can see this here with the reporting rules that the FCA has imposed and the data that it's going to be collecting from firms on this. Have the next slide, please. So, renewal transparency. This was the FCA's previous attempts to address differential pricing, been around for a few years now, where you had to and basically these rules still remain. So you still have to disclose last year's premium on the renewal letter, and you still have to give the shopping around messages on the renewal notices. I mean, I think one thing, you know, I would say is that the FCA was cross with the slow implementation of these, you know, renewal transparency rules, and named and shamed some firms. And I think these pricing requirements rules, pricing practices rules, are much bigger. And I believe the FCA will be doing the same. So I think, you know, you don't want to be one of those firms that will be named and shamed. And I'm, you know, obviously attending this webinar today, I think obviously shows, you know, you're taking it seriously and are thinking about it. There might be some firms out there who are still, you know, unfortunately ignorant of the rules. Next slide, please, Nick. So that was the pricing section. Some other rules that the FCA have introduced alongside this is a new rule about the cancellation of auto-renewal. And, you know, and I suppose it works alongside the pricing rules. What they are trying to do is that customers are not inadvertently renewed and can make an informed decision about their renewal. So we've got some new rules in this area. It must be, and these rules come into force again alongside the other rules on the 1st of January 2022. It must be an easy and accessible for the customer to opt out of the auto renewal, and that applies to all retail general insurance products except private health, medical, and pet insurance. And the reasons those are outside those rules is because, you know, obviously, as you know, they would have often have pre-existing conditions. And so if the customer, you know, moved, they may struggle to renew with equivalent cover elsewhere. Disclosures on the right to opt out of auto renewal required at new business and renewal, and that cancellation of the renewal can be at any point, you know, point of purchase or at any time during the duration of the policy. So if you got some of your contracts that are covered by auto renewal rules, again, another piece of work, separate piece of work to look at those and how can you ensure that you are complying with the new rules on auto renewal that come in on the 1st of January 2022. Next slide, please, Nick. So now moving to the you thought that was bad. Moving to the big section, then product governance requirements, which I think, as I said earlier, I see as the bigger piece, certainly in the longer term. And this is the strengthening of existing requirements. Now, you know, these existing requirements haven't been around for that long. You know, they came out, you know, in 2019, the finalised guidance paper 19.5, and that's going to be withdrawn. And so I think that just goes to show that, you know, this has been a constant focus of the FCA, and they are still not happy with it. The new rules come into force on the 1st of October 2021, so a couple of weeks time. And I think, you know, in the wider context, I mean, insurance has been at the forefront of product governance and product value. You know, the FCA is looking to roll this out across financial services wider with its proposed consumer duty that you may have heard of. For those that haven't heard of the consumer duty, it's a proposal at the moment, but, you know, in shorthand term, it's an enhanced TCF. It's an enhanced treating customers fairly, but that's perhaps a topic for a whole nother series of webinars. But anyway, I think the point I want to make is that, you know, product governance is a very serious topic. So next slide, please, Nick. So the new product governance rules. These apply to virtually all products, including those in force and manufactured before the 1st of October 2018. And those those history students amongst the audience will know that that's the date the Insurance Distribution Directive, the IDD, came into force. And these rules apply to all personal lines products, protection products, and I think this is the area that's perhaps surprised a number of people then and waking up to it now, and commercial risks, with the exception of large risks, and that's a defined term in IDD, so you should know what that is already. So therefore, almost all insurance brokers are going to be affected by this, as there is requirements on both the manufacturers and manufacturers and distributors of products. Next slide, please, Nick. So value is a big FCA thing, and FCA's definition, and again perhaps another rule to take away and keep at the forefront of your mind. Value means the relationship between the overall price to the customer and the quality of the products and or services provided, and that's from the prod section of the FCA handbook. And so I think you can tell from that definition it's judgmental, and the FCA concedes that and recognises that, is putting the onus on the firms. It hasn't come out and said commission above X% is poor value. So it's put the onus on the firms to decide whether their products are offering value or not. But it has referred back to things that we should be familiar with, the IDD's customers' best interest rules and the value measures data. Now, the value measures data rules are in force now. Again, they've been around for a while. They were tested on a few products for a number of years, but have now been rolled out across all personal lines products. And the first reporting on that is this second half of 2021, with the value measures data coming out early in 2022. So FCA wants that to be used as part of the MI that you use to determine whether the products have value or not. And then another FCA mantra at the bottom of that slide: the FCA expects firms to consistently place their customers' interests at the centre of their business. And I think obviously you can see that value plays a big part in that. Have the next slide, please, Nick. So here are some value examples that the FCA has commented on or taken action against. So Express Gifts, that was a catalogue firm, and they were offering their customers insurance against theft or accidental damage about goods that they bought through the catalogue. Very low claim frequency and payout, given that most of the goods that people bought were wrapping paper and underwear. You can perhaps see why. Now, joking aside on that, Express Gifts and other catalogue firms offering those products ended up paying their customers tens of millions of pounds of redress. Carphone Warehouse, that was a £30 million enforcement fine. They weren't checking whether their customers was already covered, i.e. they might have had mobile phone insurance under their household policy, and so were selling on cancellation. Liberty Mutual, another one in the mobile phone space, and an enforcement fine where their outsourced claims provider was putting up barriers to claiming and complaining. Basically their starting point was everyone's a fraudster and working from there. And then in the protection market, over 50s life cover, the FCA called this out recently in a letter to the life insurers in their portfolio letter, that some people will end up paying more in than they can ever get out in a claim. And so question, does that have value? FCA has also called out buildings insurance for leasehold properties, and where is the customer tenant getting value, and in a way widening who the customer is. And perhaps in the past the property managing agent may have got a lot of commission and really not worried about how much they're paying for their insurance, because they're just going to pass that on and recharge that to the tenant. Well, that now is something that's going to have to be looked at from a value perspective and from the the customer being the tenant. So that could be an interesting area. And then finally on this slide, COVID-19, and the FCA has put out guidance at the start of the pandemic and has done some sort of follow-up work that do products still offer value when they've got exclusions and changed circumstances. Just an example on that, and this may have applied to some of you. British Gas kindly sent me a £50 or £60 refund because they couldn't get out to sort of service my boiler during lockdown and things. So I think that hopefully helps you see some examples where the FCA thinks that there isn't value. Now, hopefully that doesn't apply to your products, but it gives you something to work with. Next slide, please, Nick. So it's important to determine who is the product manufacturer in the distribution chain. I mean, distribution chain has been a long-running piece of work and topic of interest to the FCA, a number of thematic projects in that space. But usually the product manufacturer is the insurer, but there may be times when there's a sort of co-manufacturer or an MGA, for instance, and but it's important to confirm who this is and put it in writing. I mean, the other, can't stress this enough, and as Chris said already in the introduction, there's a need for all parties to work together on this. And this needs to be done for each product line, and there needs to be a robust product governance framework, and we'll come on to that in a later slide. So, reason this is important, that more of the requirements sort of bites on the manufacturer, but obviously you need to agree who the manufacturer or co-manufacturers are in a distribution chain. Next slide, please. So what is it that you are looking for under product governance? So the FCA has set this out as the manufacturer should consider the product design, who the target market, who the audience is, who is this product intended for, and perhaps more importantly, who is it not intended for? What is the nature of the cover that is being offered to the customer? And then this is the big one, I think the third one there, the distribution arrangements, including the remuneration in the distribution chain, the difference between the risk price and the price paid by the customer. Who are the types of customer? Are there any vulnerable customers? Is this product designed for vulnerable customers? Is it not designed for vulnerable customers? Again, vulnerable customers is a big FCA area, again, possible topic for another series of webinars. And are there any particular notable product features, such as unusual exclusions? Ultimately, and it is judgmental, but what we are looking for here is whether the product provides fair value to the customers. Would you be happy? Ultimately, question: would you be happy selling this product to your mother? Or, answering the question: this product provides value because ... Have the next slide, please, Nick. And then for the product distributor, the requirements, receive information from the manufacturer or manufacturers on the value assessment. And again, harking back to the point that Chris and Ecclesiastical made, everyone needs to work together on this. And then consider the impact that the distribution arrangements, including any remuneration it or another person in the distribution chain to which it belongs receives, has on the overall value of the insurance product to the customer. So you've all got to work together on this and cooperate. this again is a requirement for all products in scope. Reviews must be undertaken at least every 12 months. So by the 30th of September 2022, or more frequent if risks are identified that the product is not delivering fair value. An example of this may be, you're getting a lot of complaints on a product. That may need, you perhaps should be a warning sign to you that actually, is this product not offering value? Let's put it through our product review process. And again, what are you doing? You're considering product value, you're ensuring that value remains. Now, the FCA has put words such as, you should do a product review, you should look at it for a reasonably foreseeable period. So that might mean longer than just the next renewal. And I think the things that it's calling out there are things like, life insurance, as we touched on earlier, where perhaps you should be looking at the customer's lifetime, or some pet insurance where again perhaps you should be considering the life expectancy of the animal. I think what it's getting at there is that customers may drop out and not renew really before they've got a chance of getting a claim, and that if firms know this, then they should be designing their products accordingly. Obviously, as I said there, all products reviewed by 30th of September 2022. I wouldn't leave this till the 29th of September 2022, and in fact, you may want to have a plan, and I think that's what the FCA is looking for from 1st of October this year, that you've got a reasonable and a sensible plan that all products will get reviewed by 30th of September 2022.